ASML Holding NV, stock ticker ASML, develops, produces, markets, sells, and services advanced semiconductor equipment systems. Founded in 1984, ASML is now a $268 billion by market cap technology behemoth that employs nearly 40,000 people. ASML is a semiconductor industry leader, providing chip makers with everything they need, hardware, software, and services to mass produce patterns on silicon through lithography. The company is primarily known for its specialized EUV lithography machines, a market that ASML has cornered. It's estimated that it has a 90% share of this market. Morningstar says this about ASML, and I quote, ASML is the predominant supplier of photolithography equipment for semiconductor manufacturers. We expect it to materially benefit from the proliferation of extreme ultraviolet or EUV lithography at leading-edge chip makers, which we believe justifies ASML's wide economic moat rating, unquote. So we have two extraordinary aspects about ASML, which makes the business extremely appealing for long-term investors. First, ASML's EUV lithography machines are required for the manufacture of advanced chips. Second, these complex machines, costing well over $100 million each and made up of thousands of parts that have to be shipped in dozens of containers, are essentially only provided by ASML. This monopoly over necessary machines to manufacture necessary products that the world depends on has turned ASML into a business that practically prints money. Revenue and profit are high, recurring, and growing at a fast clip, which has led to a dividend that's growing at a fast clip. Already, ASML has increased its dividend for 13 consecutive years. Per the company's own words, and I quote, ASML aims to distribute a dividend that will be growing over time, paid quarterly, unquote. I like the sound of that, and there's no doubt that ASML has been making good on this. The dividend more than doubled between fiscal year 2019 and fiscal year 2022. That's good for a compound annual growth rate of 34.2%, which is an incredible rate of dividend growth. Yet the payout ratio is still only at 41% based on fiscal year 2022 numbers. That leaves plenty of headroom for more strong dividend growth, which ASML is clearly committed to. Now, the stock only yields 1%, so one does have to sacrifice some yield in order to gain access to that high dividend growth rate, which I think is a more than fair trade-off to make. Notably, this yield is 10 basis points higher than its own 5-year average. For long-term dividend growth investors who lean toward the high-quality compounders rather than those yield plays out there, ASML is very promising. Looking at business growth, ASML advanced its revenue from 5.2 billion euros in fiscal year 2013 to 21.2 billion euros in fiscal year 2022. That's a compound annual growth rate of 16.9%. World-class top-line growth here. Very impressive. Meanwhile, earnings per share grew from 2.34 euros to 14.13 euros, which is a compound annual growth rate of 22.1%. Truly outstanding. There were some modest share buybacks over the last decade, but significant margin expansion caused much of the excess bottom line growth. Looking forward, CFRA believes that ASML will compound its earnings per share at an annual rate of 25% over the next 3 years. To accelerate bottom line growth off of an already outstanding level, especially at a base that's larger than it was a decade ago, would be a magnificent achievement. As high as it is, it doesn't seem unrealistic at all. It can be supported by really high sales growth, which ASML is achieving and guiding for more of. In fact, ASML just raised fiscal year 2023 year-over-year sales growth guidance in its recent Q2 report to 30% from a prior 25%. In that same quarter, ASML registered net profit that was up 35% from a year ago. CFRA lays out the investment case well with this passage, and I quote, ASML has a monopoly position supplying lithography systems to leading-edge logic and memory DRAM customers and a large market share position supplying immersion systems for trailing edge fabs. As clients expand their capacity to meet secular demand trends and migrate to more advanced nodes, technology transition spending remains resilient. This should continue to drive ASML's sales in the medium medium term, unquote. Fabs are being built all over the world in order to meet increasing demand for the high-end chips that are powering more and more elements of everyday life in modern-day society. And with geopolitical tensions between China and Taiwan, approximately 90% of the world's advanced chips are manufactured in Taiwan, the global build-out of fabs is also meant to reduce reliance on this one country. Well, all of these fabs will require the machines that ASML and ASML alone makes. If that's not a clear-cut long-term investment case, I don't know what is. Taking CFRA's projection as our near-term base case for EPS growth, which is basically backed by ASML itself, that sets up the dividend to continue growing at a similar rate. A dividend that's growing at well into the double digits easily sets up a scenario for double-digit annualized total return, assuming no collapse in valuation. This is extremely compelling, especially if one can wait for the dividend to grow into a meaningful amount of income. Moving over to the balance sheet, ASML has a fantastic financial position. The long-term debt-to-equity ratio is 0.4, while the interest coverage ratio is well over 100. Furthermore, cash and cash equivalents add up to more than twice that of long-term debt. This is a fortress balance sheet. Profitability is superb. Net margin has averaged 25.9% over the last 5 years, while return on equity has averaged 38.4%. Very high returns on capital here. Fundamentally speaking, ASML is one of the highest quality businesses that I've ever seen. And with economies of scale, a monopolistic market position, R&D, IP, an entrenched installed base of machines, technological know-how, and high barriers to entry, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The semiconductor industry is cyclical, and ASML's machines are very expensive. Geopolitical tensions have led to the restriction of high-end equipment sales to China, which could reduce ASML sales. Taiwan accounts for nearly 40% of ASML's sales by geography, and Taiwan is under constant threat of war with China. Technology changes fast, and ASML must continue to invest in R&D and stay ahead of the curve. ASML has customer concentration and is dependent on only a few major global semiconductor manufacturers. Being a global company, ASML has exposure to different currencies. I see considerable risks here, especially in terms of Taiwan, but this is also a business of considerable quality. And with the stock down more than 20% from its all-time high, the valuation is worth considering. The price-earnings ratio is 33.2. Is that too rich for one of the world's best businesses? I don't think so. It's quite a bit lower than its own 5-year average of 41.6. The sales multiple of 9.5 is also below its own 5-year average of 10.8, and the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a two-stage dividend discount model analysis. I factored in a 10% discount rate, an 18% dividend growth rate for the next 10 years, and a long-term dividend growth rate of 8%. This is a rare case in which the expectation for a dividend growth rate of almost 20% over the near term could actually be conservative. After all, ASML has demonstrated the willingness and wherewithal to grow its dividend at a much higher rate than this, supported by an earnings per share compound annual growth rate of over 20%. Moreover, the near-term forecast for EPS growth, which is over 20% annually, would easily support an 18% dividend growth rate. This view is further bolstered by a low payout ratio and a clean balance sheet. When I come across an exceptional business, I value it as such. The dividend discount model analysis gives me a fair value of $776.11. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates ASML as a 4-star stock with a fair value estimate of $750. CFRA rates ASML as a 5-star strong buy with a 12-month target price of $848. We've got a decently tight consensus here. Averaging the three numbers out gives us a final valuation of $791.37, which would indicate the stock is possibly 14% undervalued. Here's the bottom line, guys. ASML holds holding NV is one of the best businesses in the world. It effectively operates as a monopoly, which results in producing some of the most impressive numbers I've ever seen, with an acceptable yield, a sky-high dividend growth rate, a low payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 14% undervalued. Dividend growth investors who are looking for a terrific business to help them aggressively grow their wealth and passive income ought to have their eyes on this name. And now for a special news announcement. Williams-Sonoma Inc., stock ticker WSM, recently reported Q2 earnings easily beating on the bottom line. Guidance was also raised. The market cheered this, sending the stock up nearly 14% on the day. We covered this great home furnishings retailer back in May, highlighting it as a debt-free gem of a business. If it's not yet on your radar or in your portfolio, it might be time to change that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates a passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and am often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.